All right, let's get right into it. We're going to break down one of the most absolutely wild financial events in recent memory. We're talking about a single day that completely vaporized years of gains in precious metals in just a matter of hours. So the day was Friday, January 30th, 2026. And this number, negative 31.4%. That was the gut punch, single day loss for the price of silver. I mean, think about that. It was the biggest one-day drop in modern commodity history. Just brutal. And the fallout from this? Whoa, it was just immense. We're talking an estimated $5 trillion in value just gone, erased from the gold and silver markets in a single day of trading. You know, analysts didn't even call it a crash. They had a better term for it, a liquidity wipeout. So you got to be asking, right, what on earth could cause something this violent, this fast? Well, it wasn't just one thing. And to really get it, you have to look at what was happening for years beforehand. We have to understand the 5-year supercycle that basically set the stage for all of this. You see, the massive rally that came before the crash didn't just appear out of thin air. Not at all. It was the result of years of structural pressure building up and up and up in the global financial system. It was like a perfect pressure cooker, just waiting to blow. Okay, so let's rewind a bit. This timeline really lays out how the whole thing was built up piece by piece. Starting way back in the early 2020s, you had central banks all over the world starting to lose faith in paper money. They started buying gold like crazy in a trend that people called de-dollarization. Then, by 2025, the US Fed starts cutting interest rates aggressively. That created what we call deeply negative real yields, which is just a fancy way of saying inflation was way higher than any interest you could earn. And that supercharged the debasement trade. And this debasement trade idea, it was really the heart of the whole rally. The strategy itself is pretty simple. When you believe your government is just printing way too much money, running up debt, and basically destroying the value of your currency, you get out of that currency and you buy hard assets. You buy things like gold and silver to protect your wealth. And for years, that was the main story driving everyone into metals. And this chart right here just shows you how completely insane things got at the very end. In January 2026 alone, silver was up an astonishing 70%, gold up nearly 30%, and the stock market basically flat. Silver was acting like, as they say, gold on steroids, and it was pulling in a massive amount of speculative money. So you've got this market that's already red hot, right? What happens next? Well, a series of geopolitical shocks in a single month comes along and just pours gasoline all over the fire, turning a hot market into an absolute speculative frenzy. Honestly, January 2026 was just pure chaos. It kicked off with China restricting its silver exports, which immediately squeezed the global supply. Then the US hits its European allies with tariffs over a dispute about Greenland. After that, a US naval blockade of Venezuela sends the oil markets into a panic. And to top it all off, the US sends a massive naval fleet toward Iran, and suddenly everyone's afraid of a major war. I mean, in just a few weeks, the entire global trade system was fracturing, and investors were desperately scrambling for the classic safe havens, gold and silver. So at this point, the market has gone completely vertical. The pressure is at its absolute peak. And then, on one Friday, a single announcement hits the wires, and the entire thing comes to a violent, crashing end. The pressure cooker's valve was finally and violently released. So what was this big announcement? It was President Trump's decision to replace the Fed chair, Jerome Powell, with a guy named Kevin Warsh. Now, to the market, this wasn't just a personnel change. It was a complete regime change. Powell's Fed was seen as the one fueling the metals rally with easy money and low rates. Warsh, on the other hand, was seen as an inflation hawk, a guy who would prioritize a strong dollar and fight the very things that made gold and silver soar. The entire thesis for the trade was flipped on its head in an instant. But it wasn't just a change in mood that caused the crash. Oh, no. The actual mechanics of the market itself acted like an avalanche. For one, the markets were wildly overbought. Technical indicators were screaming red at levels not seen since 1980. Then the exchange hiked margin requirements, which forced anyone with leverage to sell immediately. And once prices fell past a certain point, the automated trading algorithms kicked in, selling everything in sight and just accelerating the whole terrifying decline. Okay, now this is where the story gets really, really interesting. Because while the paper price, the one you see on your screen, was absolutely crashing, a totally different story was playing out in the physical market, where people trade actual real bars and coins. And this was especially true for silver.
See, what a lot of people were missing is that silver isn't just a monetary metal anymore. Far from it. It's become a critical strategic resource for, well, pretty much the entire global energy and tech transition. You've got massive demand coming from solar panels, from electric vehicles, from AI, from 5G, all of which was creating a huge supply deficit in the physical market.
And this slide really gets to the core of the whole tension. You had two completely different markets. In the paper futures market, the leverage was just insane. At its peak, there were as many as 356 paper claims for every single ounce of actual physical silver in the vaults. But in the real world, people were demanding delivery, there was a run on the COMEX vaults, and China had banned exports. So the paper price collapsed, but the demand for the real physical stuff was actually getting tighter and tighter. A total disconnect. Now, what's so fascinating is what happened next. You'd think after a historic crash like that, Wall Street would run for the hills, right? Wrong. The major institutions actually saw it as a reset, not the end of the bull market. Just look at these year-end forecasts. They're still incredibly bullish. Some, like JP Morgan, even saw a path to over $8,000 gold. They believed that the underlying structural reasons for owning metals, yeah, those hadn't gone anywhere. And that really is the key question this whole event leaves us with, isn't it? The speculative fever, the bubble part of it, was clearly broken that day. But the core drivers, the de-dollarization, the geopolitical chaos, the massive and growing industrial demand for silver, all of that is still very much in play. It really forces us all to ask, in a world that seems to be getting more and more unstable, what is the true price of physical safety?